I do want to kind of talk about where we are in the equity cycle right now, particularly against this backdrop where macro interest rates in the Fed are starting to kind of dominate a little bit more of the conversation. There's been sort of this rotation within equities now for the last few weeks. And I am curious if there's sort of any evidence that maybe people have finally said, okay, we've made some great profits over these last 3.5, 4 years. Maybe it's finally time to take those chips off the table and move them to somewhere safer.
That's a great question, Romaine. Thanks. I would say that, as you mentioned, we have seen that the equity markets have been doing very well for the last 3.5 years. If you invested in the S&P in 2022, you've doubled your money. As we know, in many single name stocks, you've done much better than that even. So we always talk about the fear of missing out, FOMO, and I would say what I'm seeing right now with the clients is fear of getting out, or FOGO, which means you've already had a lot of gains and you're sort of realistic that you might not have that many more gains to go in this cycle, but you don't really want to take any chips off the table. So we're really not seeing that yet, where clients are making those rotations. I
am curious, though, about sort of the interplay that if money does start to come out of equities, does it by default go into treasuries? Does it by default go into high-grade corporate debt?
Well, one thing we like to look at is the free cash flow yield compared to the treasury yield. And right now what we're seeing is that the free cash flow yield on a forward basis is about 3%, whereas in a 10-year treasury you get 4.5%. So normally you would expect that equities would have a higher yield than treasuries. So we do think that that argues for the relative value of fixed income here.
It's interesting, you bring up the 10-year yield as sort of a starting point, but it seems like investors at large are really hesitant to step outside of the very front end of the curve. I keep hearing calls for the belly. I keep hearing calls, too, to maybe just take a look at money market funds, especially if we're not in a rate cutting cycle for the Federal Reserve. I mean, how are you thinking about duration and where exactly the sweet spot is?
That's a great question. One thing I would say is I'm not that afraid of duration. We encourage our clients to buy and hold a lot of their bonds. And so if you can lock in a 6% yield, which is what we're getting right now in IG credit, we think that's a good enough, attractive enough yield that most of our clients are happy with that. So we're okay with duration here. One more thing I'll add to that is that we don't exactly know what the the new Fed chair will say next week. But my instinct is that we can fade this hike a little bit. I think this Fed wants to keep rates where they are, and they'll find reasons to do so.
Yeah, just over a week to go until that debut Fed meeting for the new Fed chair here. I want to talk a little bit more about...
Is that going to get higher ratings than the Knicks Spurs last night?
Wouldn't it be amazing if it did? It'd have to be something pretty amazing to happen there. But let's talk a little bit more about corporate credit, because you mentioned IG. How are you sizing up the relative attractiveness, what you're getting in blue chip bonds versus high yield as an asset class?
Yeah, I think it's okay to lock in duration for the clients that have a little bit less risk tolerance, but actually high yield is interesting as well. If you are afraid about the long end exploding, high yield is a shorter duration asset class. You get that carry. And right now we would say carry is king. So we don't necessarily think you're going to get a lot of capital appreciation on your bond portfolios, but you can carry them. And with the economy in a solid spot, we shouldn't worry too much about credit here.
We'd be remiss in not asking you about what is supposed to be a relatively big data point tomorrow morning, and that is the update on CPI. Most people expect it, at least based on our economist surveys, to be at least on a headline number back above 4%. I guess my question is more so not necessarily whether it's transitory, but whether this idea that with inflation still pegged well above the 2% target, whether you're talking about core CPI or the core PCE or headline numbers, whether that changes the dynamics of what people are willing to invest in if they're getting this idea, this sense here that the Fed either isn't willing or isn't capable of bringing that number down.
Yeah. Well, that's two different questions. One isn't willing or isn't capable. Yeah. I think they are definitely capable of doing it. And if they want to, they can. I think it's a question of, like you said, what is transitory? We haven't had core PCE below 2% in over 5 years. So that would challenge, I think, almost anyone's definition of transitory. And I also think we're going to start hearing a lot more about a concept called the trim mean inflation number, which is something where they kick out the highest movers and the lowest movers, and they get sort of a middle ground inflation number. That Fed Chair Warsh has said that that's some number that he thinks is important. And if you look at the most recent Dallas trim mean inflation, it's 2.3%. So if you sort of squint your glasses a little bit, you might see 2% on that number. And so I think that they'll hang their hats on a number that looks closer to that 2% target.